everybody, my name is Stu Turley, President and CEO of the Sandstone Group. Welcome to the Energy Newsbeat podcast. I sure appreciate you guys stopping by. We've got an action-packed show today, and what's even more fun is Michael Tanner is out on assignment. He drew a tough assignment. He's out covering a bachelor party in California. So if he does not come back, we will have a report on what happened to him. But until then, we got us a great show today. We're going to start in the U.S., then we're going to work our way across the pond. There's some things going around the world. Our first story up is now the U.S. proved reserves of crude oil increased significantly in 2021. The next one, all eyes look to permitting reform as next potential energy move. This is important. This is not just oil and gas. This is any kind of energy. That's very important. ESG investment rule emerges as top woke target for Republicans battling Biden. This is an interesting article because it comes up off of a Tucker Carlson video, and I truly like Tucker. He's one of the guys out there that's pretty entertaining. Then we go around to the first step before we go over to the pond, and that is in a article titled "U.S. Refiners Expect Russian Fuel Sanctions to Keep Margins High." What does that mean to you? Higher prices. So then the EU, while we're over there, we're going to talk about EU is not out of the woods for next year. They're going to have to extend gas cut demands in order to prepare for next winter. It means that, as we talked about, they are not going to be able to fill up their reserves with LNG. It's for next year. Last one, OPEC Plus announced to leave their production quotas unchanged. So coming around the corner, let me give you a little heads up. Any of these stories are on energynewsbeat.com. Please go there, check out these stories, like on your podcast. Our podcasts are available anywhere that podcasts are released. Please also go to energynewsbeat.com. Go to the questions up there. Send us questions. We're already getting some great fan mail and some, believe it or not, fans do like us. And so send us some emails and everything else. So we're off and running. And let's go to the first story here. U.S. proved reserves of crude oil increased significantly in 2021. It's a pretty good report that just came in. The EIA report came in on February 1st. Crude oil, Texas is the state with the largest amount of volume. Let me read you this quote of lease condensate, and in 2021 had the largest net increase in proved reserves in the United States. 12% or 1.9 billion barrels, and expected to reach 18 billion barrels, which is slightly less than the 2019's record. It's pretty darn cool, especially for the Permian and for the state. We just covered a little while ago how many billions that the U.S. Texas oil and gas employees, tax money, and everything else went and paid for billions to the Texas schools. So lots of good information there for Texas. Let's take a look at the next thing here. One of the biggest problems with energy, it doesn't matter if it's wind, it doesn't matter if it's solar, it doesn't matter if it's nuclear, regulations are a problem. Permitting is the number one reason people are paying higher energy prices. I can't make it any plainer. That is a huge issue. They are slow walking everything around. They'll say that they want to do this, but it actually comes into instead of walking it down the hall, they're like putting it in somebody's drawer and leaving it for 5 or 6 months. I'm kidding, of course, but this is an analysis by Tim Tarpley. In fact, Tim, if we can get you on the podcast, that'd be fantastic. He is analysis by energy workforce president. I thought this was an outstanding read. When you take a look at the SPR bill that was put out, this comes in. He had some great quotes in here. Senator Joe Manchin tried to cobble this together at the end of last session, but wasn't able to make it happen. With the SPR deck cleared, we're increasingly hearing comments from energy leaders on both sides of the aisle that a package with the intent of easing permitting rules to expand energy production and mining critical minerals is coming together in the next few months. This is just incredibly important. Chairman Bruce Westerman said, quote, "We are going to look at much broader energy bills where we are not just focused on onshore and offshore oil and gas, but also the other components that goes along with renewable energy, with electrification and decarbonization. That's mining." I'll tell you what, this is extremely encouraging. We're going to follow this, and we want to give a shout out to Tim Tarpley with the Energy Workforce Group, and I'll reach out to him, see if we can get him on the podcast. So let's roll to the next one. There has been a dramatic change in ESG and its fundamentality impact on the whole investment energy space. The title of this next article is ESG Investment Rule Emerges as Top Woke Target for Republicans Battling Biden. I'm trying to phrase this correctly. There is nothing wrong with ESG. Environment, social, and governance are good things. When they're weaponized, they're not good things. And what has happened is that investing hypocrisy, ESG investing hypocrisy is now a thing. BlackRock lost 1.7 trillion first half of last year. Now you're seeing all these, BP announced yesterday that they are putting less focus on coming around and going into the renewable space. You had Chevron that really said, we're going to go into renewable, but not nearly as heavy. Then you had Oxy that was actually going into CCUS, carbon capture, storage, and utilization. And they're going after that as a different market. As Michael pointed out yesterday, that is an absolute wonderful thing. So what we're seeing here is the evolution of the ESG investment hypocrisy coming to full back around. So in this article, it says a couple of really, really good points. President Biden said the other day that climate change is more harmful to the planet, has the potential of harming the planet more than nuclear war. I couldn't disagree any more with him than at all. Anyway, I'm going to keep that. We'll just keep that one quiet there. The calls for environmental, social, and justice governance in the financial industry are a public relations ploy focused on placing more Twitter risk than any material risk to investors. Let me read that again. The calls for environment, social, and corporate governance, ESG, in the financial industry are public relations ploy more focused on placing Twitter risk than any material risk to investors. That was Kevin Kramer. I disagree. When we take a look at the oil and gas industry, they have done a really, really good job in looking at how they're producing oil. They are looking at the environment side of this extremely well in the US. In the rest of the world, they do not have the same standards that we have. John Thune says, equally alarming, the recently proposed federal supply climate risk and resilience rule would require certain federal contractors to publicly disclose not only their greenhouse gas emissions, but also their scope 3 emissions, compounding the burden imposed by the SEC. We covered this on one of our earlier podcasts. How can a E&P operator producing low-cost natural gas that we all need, and that people are now around the world are admitting that natural gas is needed and is being categorized in the renewable space, how can we go forward and say that natural gas E&P companies are going to be held liable for the scope 3 emissions all the way through refining and all the way down through to the car? This is a ludicrous, absolute nuts whole proposition for this. And this goes into the woke aspect of this and really changing it from an ESG good thing to being hijacked, and ESG is now becoming worthless because of it being hijacked. All right, thanks for that rant. I'm going to go ahead and go to the next one. U.S. refineries. Now this gets where it gets a little fun. President Biden went out and he said that the gasoline, high diesel prices were because of the quick Putin price hike. The Putin price hike is actually not a real thing. What's going to happen is the article is U.S. refiners expect Russian fuel sanctions to keep margins high. The reason for that is going through the whole fuel chain. It is not something that you just flat out and say, oh, I'm going to pump more gas. Tight fuel supplies expected this year will hold margins high, said Exxon Chief Executive Darren Woods, saying that a tailwind could last into 2024. Some numbers here. Marathon refining margins last year surged 81.5% from a year ago to 82 per barrel. Wow. Windfall profit taxes don't work because they come back around and then the consumers get to pay it again. This is something for us all to watch as it comes around the corner. Next one, we're going to go over the pond to EU. EU is not out of the woods. And I think everybody can remember when they were sitting back and kind of saying, hey, we're going to sit back and kind of take a look. Everybody needs to take a cold shower. Everybody needs to not have any heat on. Well, when we're taking a look at this, Michael and I had talked about that there is no way you can replace the Russian gas with LNG. Norway has stepped up to the plate and has knocked it out of the park. They are actually producing, bringing in more. They can't replace the gas, but they're bringing in a lot. LNG has taken a bunch, but they're not going to be able to fill their reserves again in the summer. So it says, assuming limited Russian exports continue, like zero, weather conditions are typical. Demand up to October 1 must remain 2023 13% than the previous 5-year average. Wow. That's going to be a big shocker. So that one's going to make some real interesting events coming around the corner. All right. Last one. This is going to be a real short one. We'll let you get back to work. OPEC Plus to leave oil production quotas unchanged. Why do you think they're going to do that? It's because they don't need to do anything. There is so much going on in the world right now revolving around oil demand. China's demand is coming up. There's all these things in play. It used to be just a basic supply and demand formula. not anymore. Anyway, well, that's it. And hey, I hope you guys have a great day. It will be February 3rd, and you guys are going to have a great Friday. Go out and have a great weekend as well, too. Thanks and appreciate you.